Hello, and welcome to the Ask About Wealth podcast. As regular subscribers and viewers and listeners know, when we have a guest on this podcast, we tend to take those guests from either the financial industry itself or indeed from the entrepreneurial pool. The financial industry to give us insight into what's out there and what's available, and the entrepreneurial pool to teach us the lessons that a lot of budding entrepreneurs would need to learn prior to going on their entrepreneurial journey, or indeed existing entrepreneurs might like to learn from, other people's mistakes, for example. Today I'm delighted to welcome back indeed Kevin Canning, who's CEO of Quintus. Welcome, Kevin.
Thanks very much. Thanks for having me back.
Delighted to have you back. You were here February, March, I think, with us. And we did say at the time we'd get you back closer to the tax season because in particular today we want to talk about EIIS, Employment Investment Incentive Scheme, and to give our audience as much information as possible so that they can decide whether EIIS is for them. And assuming they made a positive decision, decide how they might go about choosing from the various EIIS offerings that are out there today, or indeed will be out there. And I know today is the day you launch your 2025 fund, so wish you best luck with that. But recognising you were here before, but also recognising, I suppose, that our audience has expanded considerably since that time. Could I ask you to start off by telling us what the EIIS tax breaks are and how they differ from fund to fund or project to project?
Yeah, so thanks for having me back, Bob. Your growth has been impressive since, and we've got plenty of referrals since from our podcast, and you're talking on EIIS, so we're very much appreciative and excited to see where this goes.
Yeah.
In terms of EIIS in its simplest form, it is a tax relief that you get from revenue for investing in Irish companies. It can be seriously overcomplicated by many people, but as a very easy example, you invest in an Irish company and the revenue commissioners will give you a refund of tax paid.
Okay. And I'm right in thinking that the amount of that refund differs, doesn't it? Depending on the project, depending on certain qualifying criteria within the project. Can you tell us what those are as succinctly as is possible to do so?
Yeah, so there's a few different rates, and taking a step back up to about 2 years ago, there was one rate. It was just 40% tax relief. It equaled the same as your income tax, the higher level of income tax. So it was very simple and straightforward. Then the EU decided to introduce new legislation that the Irish Revenue Commissioners were forced to put into practice. So we have a tiered system now, and it can be 20, 35 or 50% tax relief. There is a third 30% tax relief that's just for one specific venture capital fund in the country. But for general punters, it will be 35 or 50%. No one really goes near the 20%.
And is the 20% in that example, is that dictated by the rate the investor is paying, or is that a particular type of EIIS investment?
It's for established businesses that are looking to invest into a new market or a new geography. So like one of the examples that revenue would always look at is, let's just say you've a business that's selling sneakers or running shoes. Been in business 20 years, but they just need a bit of capital to start selling a pair of jeans. They need to capex for new machinery, and it's a new product and selling in a new market. So if it's something like that, you can get a 20% tax relief. Now, 20% tax relief is not interesting for anyone. So I don't know anyone who ever invests in a 20% tax relief investment.
So that there's a 20% category, but as you say, it exists on the statute books, but it's not actually operational as far as you know.
Correct, yes.
Okay. The 35 to 50% then, what does that depend on?
Yeah, so the 35 to 50% is really where the whole market is, and everyone's sort of shooting for the 50% tax relief, and then sometimes getting 35. So it's some funds will do a blended, some will just go do 50. The big classification between 50 and 35 is whether you've commenced a trade or not. So pre-trading, you get 50% tax relief. Post-trading and less than 10 years old, you get 35% tax relief.
10 years old is the kind of limit, is it?
Correct, yeah.
Okay. You know, one of the things we regularly talk about here is pensions and the tax breaks that are available on those. But they're somewhat limited in that you can only get a tax break on a pension contribution if you're making that from earned income. That isn't the case here in EIIS. Sure, it's not.
No, EIS is very flexible. I mean, if you go back 2 years, the cap in EIS was sort of 250k you could invest in a year. And some investors will be capped by that. They'd be looking to go significantly more. And over the last 2 years, revenue have staged it up to 500k last year and $1 million this year. So that's pretty much as high as anyone would ever want to go in EIIS anyway. So it's been a welcome change that you can now pretty much invest as much as you want, provided you've paid the tax. And what? Sorry, what was the other?
What income can I offset this tax break against?
Yeah. So then the income, you know, in terms of a pension, it's earned income. So, you know, it's from employment income essentially, and it's unlikely you'd ever have that sort of level of employment income. So it's far more likely you'd have income from rental properties to bring you up to that level, or share options, or dividend income. If you were owning a company or invested in stocks and that sort of stuff. So all of them are covered by EIIS tax relief, where they wouldn't be covered by pension.
Yeah, very good. And as I said there a moment ago, you're launching your 2025 fund today, later on here in Dublin anyway. I think you launched it in Cork a couple of days ago. Is that right?
We did, yeah. So we do sort of an investor event once a year, one in Cork, one in Dublin. We are predominantly a Cork-based company, albeit we do have an office here in Merrion Square as well in Dublin. So yeah, we had a Cork event last week. We had about 65 people registered, about 50 came to it, and I think there's about double that tonight in Dublin. So really excited to see everyone.
I mean, I certainly wish you the best of luck with it, and I suppose. And you were gracious enough to thank us for the kind of audience we've given you historically. But I suppose it's incumbent upon me to make it very clear to our subscribers that you're not here because you're paying us to promote your fund.
No.
And certainly our view is that what we want to do is give new knowledge and new information to people. We're grateful that you've come along and agreed to offer us that new knowledge and new information.
Just on the point, I think the EIIS industry is quite opaque. There's a lot of one-off projects going on. There's about 4 regulated funds. There's not too many people that are in the space that are sort of outward reaching. We try to do a lot of stuff on LinkedIn, try to do explainers, and we've started doing our own little videos and that kind of stuff, trying to explain stuff. Other fund managers have kind of thanked us for that we're actually trying to bring up the knowledge in Ireland, because a lot of people still don't have a clue what it is.
Yeah.
So yeah, it's an interesting space, but I think everyone needs to understand the whole market and not just what my fund is or what one fund is.
Good. And I agree wholeheartedly. One of the things that I think would benefit the listeners and our viewers would be, can you explain to us how you go about choosing an investment? Because while you're maybe talking about this in relation to your EIIS fund, I mean, hopefully the process you go through will help people maybe apply that process to no matter what investment they're looking at. So what kind of due diligence do you do before you make a decision to invest?
Yeah, so even taking a step back from that, our investment criteria is very strict. And that's given us real clarity within our own fund. At one stage we'd used to use the classical Irish investment firm thing of we'll look at anything. And if you're looking at everything, you're just wasting so much time. a lot of tire kickers, a lot of stuff you don't want to look at. So we have very strict investment criteria now, and we just shut off conversations straight away if they don't fit that. So that would include, we look for companies that want to be a cash flow generating business. They need to own or be operating significant real estate. And we want founders who are investing a significant amount of capital themselves. And generally we prefer, if they're second time founders, that they actually know how to operate a business.
Right. So they've proven themselves historically.
Yeah, 100%.
And I mean, you're hitting on something that's certainly close to my heart there, which is, and I would say this to anybody considering any private equity investment, I suppose, make sure the promoters have skin in the game. So you're making sure, in terms of the companies you're dealing with, that these promoters have skin in the game.
Yeah, look, 100%. We invest in pre-revenue stage companies, so they're inherently risky if you're going for a business that has literally never made a sale before. So we mitigate that risk by having founders who've been there and done it before, putting a significant amount of capital in themselves, and ideally operating from trading businesses that trading premises that are quite valuable. So an example of an investment we recently did was a paddle court investment in Cork City. So promoters that we know who were seasoned entrepreneurs had identified the growth of paddle and that they wanted to buy a premises to operate a paddle business. So they purchased a warehouse in Cork City down by Páirc Uí Chaoimh, really nice area. And used EIIS funds to do so. Now we're fitting it out with 6 paddle courts, saunas, plunge pools, and it's going to be a fantastic sports facility right in the heart of Cork City. So that kind of ticked all our boxes. We're personally investing in the business too, and we're very excited about it. And that's the kind of investments we've done last year and will be doing going forward.
And as you said, one of the criteria is that these seasoned entrepreneurs in this example have skin in the game. I mean, can you just tell us, because it's easy to say they should have skin in the game, but maybe explain to us why it's important that they have skin in the game.
I mean, look, it's such an important piece of anything. Like, if something is going wrong and the person hasn't put anything into that business, they're far more likely to just say, "Here's the keys," and walk away. It just doesn't make any sense for someone to not have put their own cash into a business. I kind of understand it for more tech startups and stuff, and people who are starting at a young age, but big cash flow generating businesses that need assets to start from, you just can't expect someone to put up 100% of the capital.
And, if you're not willing to risk your own money, that basically tells you something about the investment, doesn't it?
Especially if they have money.
Especially if they have money, as you say. I mean, that's a good segue into the whole area of risk. And you and I were talking before we started to record here about the kind of blunt instrument at times that's used in the broader investment market to identify what type of risk somebody should or shouldn't take. And we may talk about that again in a moment. But I mean, there's no doubt, and you've said it already, Kevin, in fairness to you, EIIS investment is risky. And how do you go about explaining that risk to potential investors in this space? Yeah,
so look, EIS is investing in Irish companies that are, unlisted, they're early stage. So there is a lot of risk there. It's very different to what you said earlier about sort of your pension product, where you're investing generally in global S&P 500 companies, which are the top companies in the world. Now, with that, you get significantly different returns in terms of risk and reward. In terms of explaining risks, I mean, our fund is regulated by the Central Bank of Ireland. It goes through a rigorous process with the Department of Justice, with Revenue each year to make sure all our tax disclosures are correct. I mean, we have investment committees. We have 4 people on our investment committee that all investments have to pass them twice, at the start when we're considering a project, and at the end before we actually deposit any capital. And our fund, when we're onboarding investors, goes through all the rigorous process that any sort of regulated broker would in terms of suitability statements, all this kind of stuff. What I mentioned to you earlier was some people think a suitability statement is just a tick box thing, but like we found a few times where people just didn't really get EIS and they were looking to invest, say, 50k, but they hadn't actually paid any tax, so they wouldn't have got a refund of it. So the responsibility or the onus is on us then to tell them, like, you can't do this, that it makes no sense because you're not getting the tax refund. So there's some merits, and you wouldn't get that if you're investing in unregulated EIS products.
Let me interrupt this podcast for a moment. Do you know how to create wealth? Do you know how to limit your taxation? Do you know how to protect that wealth when you do create it? Well, if the answer is no, our masterclass is for you. Over 12 modules and 36 videos, I will personally teach you how to create wealth, how to minimize your taxations, how to protect that wealth when you create it. Check out the link below, and now back to the podcast. Right. And so, one of the things, again, when we were talking earlier, I was saying to you, and when I talk to people on consoles, I have a problem with this kind of very blunt instrument of risk analysis, because you answer a 10-question questionnaire. They decide, the scale at use in the market is broadly a 1 to 7 scale. They decide you're a 4, and therefore the recommendation is you put all your investments into a 4 rated risk strategy. What that doesn't recognise, in my view, is it doesn't recognise the different time frames to liquidity. I was talking to a chap during the week, for example, and he had a very nice pension fund, 7-figure sum, and he had this 4 risk strategy with one of the major brokers. And, I was saying to him, but, that assumes you're going to spend all your money at 65. Where you're going to spend some of your money at 65 and 66 and 82 and 91 and whatever, that this kind of blunt instrument. So in that example, I am getting to a point here. Apologies for rambling. But the point is that, in my view, certainly investors, even if they answer that scale as a 4, they can have some of their investment at a 7. They can have some of their investment at a 6, at a 5, at a 4, and so on. And, in that broad kind of risk world, where does EIIS sit? And would you agree that, even the most conservative investor has, at least should consider investments beyond that risk scale, simply because they may not be touching it for a far longer period of time?
Yeah, no, look, this is something we need to battle with every year when we are raising funds. So when we do a fund every year from, say, October to December, where we raise capital from investors, we raised 8 million last year, and you deploy it then the following year. So we talk to investors, we explain everything to them, they get the risks, you talk them through it completely, then you get to doing the paperwork. And as you said, they might be a 4, but the EIIS fund has to be a 7. Like, we'd always put it as a 7 because of what it is. It's a liquid, it's investing in Irish companies, and it is 100% a 7. And then they get the paperwork and be like, geez, you never told me this is so risky. And they're like, oh, you know what it is. Like, we've explained to you what it is. Just because some central bank form says it's a 7 hasn't actually changed anything. Yeah. So yeah, look, I think there's a place for all those. And again, I kind of bring it back to when you're a regulated entity and you're running a regulated product, you have to go through that stuff, and that's good for the industry. There's a lot of wild west stuff in this industry, so the more regulation, the better, in my view.
Yeah, I mean, I have to agree with you. I mean, regulation is a good thing, or certainly is well-meaning. At times, whether it actually delivers what it's supposed to deliver is depends on which part you're looking at.
The threat of being dragged in front of the central bank when you're regulated is very, very real.
It is, and so it should be. Yeah. In terms of the risk, you said something to me earlier which I hadn't heard before, but I'd like you to talk about. One of the things I talk about in broad EIIS is that a fund, and you do run a fund, an EIIS fund, as opposed to a direct investment. A fund can offer a couple of benefits over and above direct investment. Benefit number one, I talked about, is diversity. Benefit number two is the due diligence process you guys, as fund managers would put a business through before you'd offer it to the public. But you said something, as I said, that was interesting. You said EIIS can be over-diversified. What do you mean by that?
Yeah, so there's a few different ways you can invest in EIIS. So you can go directly into a company. So if you go directly into a company, you're just investing in that company. There's generally no intermediary. You just deal with the founder of that business. They issue you shares, and that's what you go. There's no professional manager in the middle like us. And then if you go to your fund, they will invest your capital into several different projects. Now, our fund will be one of the least diversified. We go for sort of bigger, safer projects. And like, for example, last year we invested in 3 projects with €8 million. So average ticket, average investment side was sort of €2.5 to €3 million. Other funds take a far more diversified approach than us, but we don't like that. And I suppose there's several reasons. One, we just look for projects that we really like and we can give a lot of time to. And another one is there's an administrative nightmare for investors if you invest in too many projects. So let's take, for example, if you go to a fund, they invest in 10 different projects. You actually have 10 different investments and they're all treated separately in tax returns. There can be clawbacks on each of them if they're sold early. There can be different tax treatments. It becomes very, very complicated. And that's actually why a lot of accountants and tax advisors run away from EIIS, because it's not even the risk of loss of money. It's more the do not want to deal with the administrative nightmare of trying to get these tiny little dividends or these tiny returns and amending old tax returns and stuff. So being over diversified in the EIIS world is not really where you want to be either.
Okay, and that is, as you say, from an administrative nightmare point of view, rather than if there are 10 different investments within a fund, then all 10 of those have to adhere to all the rules and regulations. And it's interesting what you say there, because you didn't say that earlier about the different tax write-offs, that if some of them are up and running businesses, they will have one tax relief, whereas if some of them are pre-income businesses, they'll have a second different tax relief. So
yeah, so our fund only invests in 50% tax relief projects, and we're the only fund in Ireland that would take that approach.
Okay.
We did it last year, and I don't think anyone else will take that on or want to take it on. Now, one reason why we did that was because with taxes, people want to be able to plan. So if you invest in a fund, you don't get your tax relief till the fund makes those investments.
Yeah.
So if I go to you and you're an investor and I say, give me 100,000 and I'll invest it in a mix of 35 and 50% projects, you're going to end up with a tax relief of anywhere between 35 and 50%. So you could end up with 40.8% or 45.2%. Makes it very hard for you to plan your tax return and how much you should invest in this sort of stuff. So we took the approach just from last year. We're going to invest solely in 50% projects. We were a little bit iffy about doing it last year because we weren't sure if we could achieve it. But look, we just achieved it. We did it. And we're very confident in sort of doing it going forward. But yeah, different funds for different people.
And not only is there, if you look at a fund with 10 individual investments within it, not only is there different tax breaks, as you say, but also you said there, the funds have to be invested. So could it be with a diversified fund that you might get the tax relief itself over different periods of time simply because it took the fund longer to put the money in?
Yes, look, it's a key point that anyone should consider if you're investing with an EIIS fund, is seeing what they have lined up and when the funds will be deployed. So let's just say, for example, I want to raise €10 million now for this fund. It would be better for my business if I raised €20 million because I get paid as a percentage of AUM. But if I raise €20 million, it's highly unlikely I'll have that invested by next year's tax season. So I'll be essentially screwing over some of my investors by not having the funds invested. So you need to be very careful when you're investing with a fund saying, Do they have a cap? Do they have investments lined up that they're actually looking to invest? Or are they just filling their coffers as much as possible?
With the hope of finding
and actually not really caring if you have your tax relief for 31 October next year. So it's all about that for investors. You do your tax return in October next year.
Yeah, because if you run your IRRs based on your tax relief, then time value of money comes in, doesn't it, in terms of that regard?
Well, that as well.
You don't get tax relief for 2 years.
Yeah, that as well. But like a lot of people will have factored into preliminary tax payments for their rental profits or these kind of things.
Yeah.
So if you're planning for having 50 or 40% tax relief, whatever it is, and then suddenly only half the funds are invested, you're going to be quite annoyed.
Can I bring you back to the skin in the game piece we were talking about a minute ago? Because, when I talk to people and broadly say make sure the promoters have skin in the game, I don't only mean the seasoned entrepreneurs that you talked about in paddle, but I also mean the fund manager.
Yeah.
Is that, from that perspective and in your business, do you as an individual, does your company as a promoter, does it have skin in the game?
It does, 100%. So industry standard in kind of private market investment firms is for the GP commit or the general partner, which we would invest somewhere between 1.5% to 2% of all deals. Now, if you think across multi-assets, that's quite a lot. Our EIS investments annually is in and around 10 million. But our business this year will invest somewhere between 30 to 35 million. And
you and your business partners will invest 1 to 2.5% of that total.
1.5% to 2%.
1.5% to 2%.
Yeah. So we've just done it with one of our investments. It's a large investment, and we've done sort of in and around 200,000 between us as an investment. So,
and that's important. I think the learning for the listener is that, not only does the promoter behind, the person getting the money, as it were, in the entrepreneurs, but that you as fund manager and indeed any fund manager they choose to deal with have skin in the game, because if you do, then what's good for you is good for your client. What's bad for you is bad for your client. And that's why skin in the game, I think, is so important.
Yeah, 100%. And you want to make sure the terms of the skin in the game are relatively similar too.
Yeah, good point. Tell me a bit more about that.
Yeah, look, it was something that we were talking about there, even internally. Me and my investment manager wanted to invest in one of our projects that our fund went into last year. They were doing sort of a direct family investment, or friends and family investment. And we were thinking about going into that round, but we decided against it because at some stage our fund might not align with the friends and family. And if that does end up happening, we don't want to be sitting on the friends and family side. We need to be representing the fund side.
Okay.
So you need to be careful how you go into a project. You don't want to be like the equity in a project when the fund is going in maybe as redeemable sort of debt, and then you're suddenly stuck on the wrong side of an argument against your fund.
Yes.
So yeah, you need to be investing alongside your investors on the same terms.
On an equal footing.
Correct.
As we say, what's good for them is good for you. What's bad for them is bad for you.
Yes, correct.
Okay. In terms of just looking at the history of these funds, and I know EIIS is its forerunner was BES. Have you any view or any information about how successful or otherwise this has been, both, I suppose, as an employment investment incentive scheme, which is about creating employment in an economy. Regularly we hear ministers on the radio telling us we're at full employment. So if you're, but has it been successful in achieving its goals from an employment point of view? And in terms of the investors' returns, has it been broadly successful? And, if you have data about the market, please let us know. And I'm sure you have data about your own funds and how successful or not they've been. So
I'll start with the market approach first, because they're two very different questions and outlook. So Look, it's very successful for Ireland as an economy. When we were going through all the changes a couple of years ago with the Department of Finance and Revenue, there was in and around 60 million a year being invested through EIIS, and about 40 million of that was going through the funds. So they were really, really important. And we were investing in projects that a lot of them aren't that sexy, and they don't really get a lot of the investment that private individuals would go into. Like, everyone always talks about the venture funds and the tech businesses scaling and that kind of stuff, and gets a lot more press and PR. But I mean, we're more interested in the providing sort of social infrastructure to Ireland. Like, for example, we've invested in a creche business that's going to have 10 creches operational. By the end of, in about 2 years' time, they'll have 10 creches operational, having over 1,000 kids. Everyone knows that's a huge problem in Ireland. There's no venture capital investment going into that. It's too early for private equity firms. So like, the EIS scheme is really, really important to that kind of stuff. And it is growing and scaling the use of EIIS. So that's kind of from an economy perspective. I think it's really important. From an investor perspective, like, there is no way any of these investors are investing in these projects if they're not getting the tax relief. They will go away and they'll just invest in the S&P 500, and they probably should. It'd be a lot less riskier, a lot safer, and you'll have access to your cash anytime you want. So the tax relief needs to be there to make this attractive. I've seen you do your calculations on some of the funds that might say it's a 20% capped return over 4 years, and that's a pretty terrible investment without the tax relief. But you add in 50% or 35% up front, and it suddenly becomes a lot more compelling. You're jumping from an IRR of probably 4% to about 17, 18%. In terms of, has it been successful for investors? There's a lot of investors who've been burned by EIIS projects in Ireland, especially away from the regulated fund space. There's a lot of bad actors in the space. And I would just always urge people to, go through an investment professional and someone who's actually done their DD, invest through a platform. Don't just give your money to some random founder. Or if you're going to do that, maybe do it through like HBAN or one of these angel networks, that there's a group of you collectively investing. I don't really encourage anyone to ever invest on their own directly into stuff with no professional DD done.
Yeah, because of the protection that gives them.
Correct. And look, I was even explaining it to you earlier that one of our business partners invested in our business because he wanted to invest as a group in other businesses. It's very hard, even as an investment professional, to go investing on your own. You need a professional team to actually do that work, that are paid on a daily basis to do this. Even if you're one of the top investment professionals in Ireland, you're going to struggle on your own. It's
interesting you say what you've said there. I often say to people about, on my consults, you think of me as a financial GP in the sense that, a GP knows, quite a lot about most things, but there are times when specialists are needed. You don't go into your GP office with a pain in your heart and expect them to take out a scalpel and open you up. That's when you call in the specialist. That's when the cardiologist is referred. And I think what I'm hearing, and I 100% agree with you on this, this is a specialist area. This is not, even the GP himself wouldn't, or herself wouldn't open up their own chest. That's when they go to their own specialists. And this is a specialist area and requires specialist advice and due diligence.
And yeah, look, one of the private markets in general is becoming a very interesting space and very active space. Public markets were all the rage when I was in college and everyone wanted to be a stock picker. It's all ETFs now. Everyone is just, invest in the S&P 500. There's, the private markets is a lot more interesting and a lot more active. But with that, it's a lot more specialist and nuanced too. There's little private market segments and different investment firms. So like, yeah, you really got to know where you're going and deal with the right people. A lot of financial advisors in Ireland are a bit afraid of the private markets for good reason, and there's been some high profile cases in that regard. But like, we try to be out front and center, meet our investors face to face, It means a lot to people when they can kind of look you in the eye, and even doing podcasts like this and stuff, people see you're a real person and talk to you, and they're far more likely to reach out and meet you for a coffee.
Go back to the success of it for me for a second, and have you any idea, or is there any data that you're aware of that tells us how many jobs have been created by what is, let's face it, named Employment Investment Incentive Scheme? Is there anything you can tell us about that? How it's better? I mean, one of the points I make to people in general, and in whatever format we're communicating with that audience, is that tax breaks, for the most part, while they benefit individuals who make the investment directly, they benefit society too. We wouldn't have the wild Atlantic Way without tax breaks.
Yeah.
We wouldn't have places for your elderly parents to be looked after without tax breaks. So can you, how back to that question, how many jobs do you think it has created, if you know at all, and what benefit to society has been delivered?
Yeah, it's an interesting point. So like part of the tax legislation is there can be a clawback of part of your tax relief if you don't create at least one more job than when you invested in the company. So it is actually built into the tax relief that you need to create employment. Now, to my mind, it's very opaque on what is in jobs have actually been created. I've never seen any facts and figures on it, but funny enough, you mentioned it. It is something we were discussing internally recently about using it for sort of PR, because it is something people want to hear about and want to see. Even like, okay, I invested in this fund and invested in 5 companies, and they created 500 jobs over the 4 years. That's a really good news story for the country and for EIS and funds. So we actually are actively reaching out to all our companies at the moment and asking them these facts and figures about how many people do you employ now, how many people did you employ when we invested. We do think it's a good news story.
The information will soon be available.
Yeah, well, just for us.
Or certainly within your bailiwick, as it were.
Yeah, don't know about the other funds.
That leads me on to you mentioned about returns, and am I right in saying that the funds in general and your fund in particular, you predict a return in advance in terms of this, in terms of what you're aimed at? Broadly, what kind of return, I think you've mentioned it there a moment ago, but what kind of return would you say people investing in EIIS should reasonably expect, assuming a positive outcome, of course?
Yeah, and look, different funds take different approaches here. In general, our investment philosophy is get the highest tax relief and don't lose the capital. That's generally as our kind of starting point, and that's what our investors want. Other funds would have a lower tax relief and they'd more shoot for the stars and kind of go for venture style returns. So ours is more sort of simple, basic, don't lose my capital. Other ones might go for higher returns and they'll offset losers. So in our fund, we invest solely in 50% tax relief, and as a result, we try to cap the return at 20%. Some of them are higher, certainly are higher, but that's sort of the bog standard. Invest 100k, get a 50k tax relief in year 1, and get back 120 after year 4.
So that's a 5% coupon, isn't it, over 4 years? I mean, and tell me about that term, because there are minimum terms here, aren't there, in terms of people committing capital. They're committing for a minimum period of time, and then they're committing, beyond the minimum. What's the normal period of time, perhaps, that they're committing?
Yeah, so one of the things with the minimum period as well is it's actually tax legislation is the minimum period, needs to be a minimum of 4 years. Now, one of the biggest problems with this tax relief, and what I'd love to change, is that's not time apportioned if you sell the business early. So let's just say you invest in a business, you put €1 million into it, and the business gets sold after 3.5 years. If you've claimed 50% tax relief on that, there's a full clawback of that 500,000
on the million.
The million. So like,
even though it's gone almost all the way.
Yeah. So like, I would absolutely love if that was time apportioned and they just reclaim the 6 months of the 4 years instead of the full thing. Sure. I think would make a lot of sense. So yeah, was the question on like returns?
Yeah, well, term was it?
Term, sorry, yeah. So that's minimum 4 years. I think people need to go into EIS investing with their eyes wide open, that these are liquid private companies. They are not turning around and giving you the money at the end of year 4. There is an exit process. You might need to sell the business. You might need to do a bank refinance. Different funds take different approaches. We always sort of start with the end goal of how are we refinancing this at the end. But, you know, there are liquid investments. It's not the S&P 500 that you can just sell
in 10 seconds flat.
Account.
Yeah. And so how minimum 4 years. Can you tell us what the average is then, either across the market or indeed just in your own experience? How long before, again, assuming a positive outcome, people get their funds back?
Yeah, so a lot of the funds would structure it with sort of a capped return, but that cap can extinguish if you're not repaid within 4 years and 6 months, or there hasn't been an exit, or you might be able to force the company to sell or something like that. So in general, if it's a good return, you're going to be out within 4 years and 3 to 6 months. We try to say 3 months. If it's going longer, you're generally into like selling the business and stuff like that. It's also one of the reasons we've started investing in businesses with sort of physical assets that we could potentially sell in the future if we need to recoup investor capital.
And that is, I assume, means you have first charge over these physical assets, no?
Not first legal charge,
okay.
No. So we invest as shares in a company, so it's risk equity, albeit you might sit higher on the cap table. But if you invest as equity in any business in Ireland, you cannot take a first legal charge.
Okay.
You're not allowed from a tax relief perspective, and you're not allowed from a company law perspective.
Okay.
So it has to actually be a loan to take first legal charge.
I understand. Okay.
Yeah. But what we would do is we'd restrict companies from giving away a first legal charge.
Okay. So while you can't have it, you can make sure they don't give it to anybody else.
Yeah, so we have a lot of stuff in our investment agreements. You know, we don't want any indebtedness, future debts. We don't want the business paying crazy salaries to founders and all this sort of stuff.
Which goes all back to your due diligence process, doesn't it? In sense that not only are you doing the due diligence, but then you're introducing a set of rules that the founders and entrepreneurs work by.
Yeah, and like some people can look at that as a founder would look at it negatively. In my experience, there's very few successful companies in the world that don't have exceptional governance, that don't have monthly board meetings, don't have monthly accounts, don't have very strict rules and processes within their businesses. Businesses do not scale without that kind of stuff. So that is what we try and bring into companies. Now, the poor founders will absolutely fight that. The good ones will embrace it.
Yeah. Okay. And that might give you an indication whether you continue the conversation or not, I suppose.
100%.
One of the things also I talk about in broad terms of any investment, I counsel people to act like the spook. You know, I mean, a spook doesn't walk, or a spy doesn't walk into a room he or she doesn't know how to get out of. So exit strategy is important. Certainly in my view. How do you tackle that issue, and what kind of rules, I suppose, are you putting on your investments, and rules maybe somebody should put on their investments that guarantee that you walk into a room that eventually you'll be able to get out of?
Yeah, so if you're looking at like our type of investment, or several of the other funds would do redeemable shares. So with a redeemable shares, you're looking to be redeemed out at a certain time in, say, 4.5 years. With that, you need to sort of start with the end in mind and say, how much will I be able to be redeemed out in 4 years' time? The only ways you're going to be redeemed out is saving up profits to actually build up cash to redeem you out, get a bank loan, or potentially new equity introduced. But new equity introduced is fickle. So you're kind of looking at sort of what will the banks lend? Would it be a multiple of their profits? Then you're working out what the profits are. So you're sort of working back, and then that should give you an amount that you're comfortable with investing, knowing that you should be able to get out at the end.
Okay, so you're doing that in advance, as it were, before you commit the money. You're finding your exit routes, and you're convincing yourselves through that due diligence process that exit is possible.
100%, yeah. And look, we're talking to banks. I mean, some of our EIS investments this year have been in creches, hotels, and paddle courts. And we'd be talking to the banks and saying, what's your appetite for these kind of assets? What sort of multiples will you lend at? Talking to private credit funds, we understand the private credit space well anyway, but like what LTVs would you actually lend against assets like this and stuff? Yeah. So you're working back from there and saying, is this actually a credible investment? But yeah, always looking at the end.
Yeah, good. Just as we kind of wrap up here, trying to give somebody, I mean, you mentioned some numbers earlier, and I ran some numbers before we started to record. And if you take what you're saying, I put 100 grand into a project like this, I get 120 grand back in 5 years, or 4 years, sorry. That's a 20% coupon. How is my 20% profit in that case? Notwithstanding it might have only cost me 50 grand to make this investment. But before I get onto that bit, how is the 20,000 in that example taxed when I do get my money back?
Yeah, so it's a complex question, and again, if for everybody were looking at making changes, I'd love if they could change this to simplify it for everyone. So if it's a redeemable share, you're looking for the company to redeem it. So if the company does redeem it, within 5 years, it is income tax. Over 5 years, capital gains tax. So
and that is no matter what the EIIS company or any other share.
That's just general tax rules, nothing to do with EIIS. So income tax up to 52%, capital gains tax 33%. Now, some people might want, capital gains tax is always 33% in that instance.
Yeah.
Income tax could be a lot lower. If you're retired and you've no other income, you might use your tax credits. You might offset it against future EIS investments. So some people do prefer the income tax routes.
Yeah, there's more allowances against
more
income tax. Yeah, and more flexibility. So, but at a worst case scenario, to ski off the top of the mountain here, 52, and that is 40% tax, 4% PRSI, 8% USC broadly. That's where that 52 comes in. And
I suppose an important point there as well is, you kind of touched on it there, that if you've invested 100,000 and it's cost you 50, you're not taxed on that uplift from the 50 to 100.
From the 50 to the 100. From the 50 to the, I mean, at 52%, 20%, 120 grand turns into 110,400 after I've paid my tax.
Correct.
Which is, about a 2.5% a year return. But now if I take the 50% tax relief into account, that 2.5% a year return turns into a 21% a year plus return. So the tax break is, of course, hugely needed here to make this not only a viable investment, but there are very few investments that give you a 20% a year return. So in terms of when you promote, do you give your potential investor those kind of do you crunch those numbers for them? Do you tell them what the gross and net returns are likely to be?
Yeah, so our targeted IRs everywhere on our stuff is 17%. So we'd have
which includes the tax break, obviously.
Correct, yes. So we'd have and that would be starting with 100 as your investment and getting 50 back after 12 months or 50% back after 12 months. And then the return after 4.5 years as opposed to 4.
Okay, so that might explain the difference between your number crunching and my number crunching.
Yeah, and it's also like the time value of money has a big, on IRR calculations, time value of money.
You're taking TVM, time value of money, into that calculation.
Yeah, when you actually get the tax relief is a big thing. So if you got it after 3 months instead of 12 months, it's a big thing.
Yes, of course it is.
And same with the coupon on the other side.
Well, look, I mean, again, can I thank you, Kevin, for coming in. The last time you were here, I did say we'd probably have you back because we'll get a whole bunch of questions I didn't ask you. I reckon we might have that again. I
could ask you tonight on our panel show.
Sure, but it remains for me to say thank you again. Thank you for your time. Thank you for your expertise, and I have no doubt that I've learned a bit more about this subject today, and our listeners will have learned a bit more. From their point of view, I would say to them, again, I'm not here to promote a particular fund. I'm here to give you new knowledge and new information so that you can make better financial decisions for yourselves. Hopefully this has given you that. I would also say, as I often do at the end of these things, don't forget to subscribe. Thank you if you've subscribed already. Thank you if you're about to subscribe. Bear in mind that the more subscribers we have, the more of this type of information we can bring you. And see you next time.